Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions.
Hey there, investors. So here's the scoop. The U.S. markets are feeling a bit jumpy right now. Fear seems to be holding its grip, and it's creating a divide when it comes to opinions about the future. It's quite a mixed bag of emotions out there. Now let's talk about something interesting. Did you know that speculation in the futures and options markets can have a pretty wild impact on prices? Yep, it's true. Those markets can cause some real short-term price swings. But here's the catch. Those swings don't always reflect the true supply and demand dynamics. It's like a roller coaster ride that doesn't always match up with what's actually going on in the market. So my advice to you is this. While it's important to keep an eye on those market movements, it's also crucial to remember that they might not always tell the full story. Keep your cool, stay informed, and don't let short-term fluctuations throw you off track. Investing is a long game after all. All right, hold on to your hats because we've got some news on the economy that might just leave you a little bit stunned. Brace yourselves. The World Bank is predicting that oil prices could skyrocket to a whopping $157 per barrel. Yeah, you heard that right. $157. Now you might be thinking, hasn't oil reached crazy high prices before? And you'd be absolutely correct. The all-time high was back in July 2008 when oil hit $147.5 per barrel. But this potential surge is being attributed to the ongoing conflict between Israel and Hamas. Experts are worried that the war could spill over to other Arab nations, triggering something reminiscent of the infamous Arab oil embargo in 1973. Feeling a bit of déjà vu, aren't we? Back then, prices shot up 4 times after Arab energy ministers imposed an embargo on oil exports to the U.S. as a response to its support of Israel in the Arab-Israeli war. But here's the thing. Even a small disruption in oil production could cause a significant drop of 500,000 to 2 million barrels per day, similar to what we saw during the Libyan civil war in 2011. And that could push prices to break the $100 mark. Now imagine this, a medium disruption of 3 to 5 million barrels per day could see oil prices soaring past $109 and settling around $121 per barrel. Think Iraq war levels in 2003. And if things get really out of hand and disruptions exceed expectations, we could see oil prices crossing the incredible $150 mark. That would be a first. All this talk about oil prices might give you a headache, but let's switch gears for a moment and look at some other global economic news. In the Eurozone, inflation has dropped to a 2-year low in October, painting a gloomy picture for the economy. In fact, it shrunk in the third quarter, increasing fears of a recession. But hey, it's not all doom and gloom. Apple has just unleashed its fastest iMac and MacBook Pro models yet. And surprise, surprise, U.S. paychecks have actually grown faster than expected in the third quarter. Can you believe it? So, there you have it, folks. A mix of high oil predictions, economic ups and downs, and some bursts of good news. It's like a roller coaster, isn't it? Buckle up because the ride isn't over yet. So stocks had a bit of a mixed month in October. While the overall market inched higher, some big players like Meta and Nvidia actually saw declines of around 1%. And here's a surprising statistic. This marked the 3rd straight month of losses for stocks since March 2020. The Dow and the S&P 500 both fell, with declines of 1%, 4% and 2% respectively. The tech-heavy Nasdaq also took a hit, declining by 8% in October. But why did this happen? Well, experts are pointing to higher interest rates as the culprit. In fact, the benchmark 10-year U.S. Treasury yield crossed the important 5% threshold for the first time since way back in 2007. What's coming up next? Well, the Federal Reserve is set to announce its decision on interest rates this Wednesday, but don't expect another rate hike this year, at least according to the experts. Oh, and if you're interested, you might want to check out the news about how UAW strikes cost Stellantis around $3, $2 billion in revenue. That's quite a hefty impact. So it's been a bit of a bumpy ride for stocks lately, but let's see what the future holds. So guess what? The United Kingdom is getting ready to regulate the world of crypto. Yep, the Treasury Department over there is about to reveal its grand plan for how the digital asset industry should be regulated. But don't worry, they're not going to do it all at once. They're planning to gradually introduce new rules. Their strategy is to start with stablecoins and then later move on to the wider crypto industry. Now here's the lowdown on what we know so far. The Bank of England, the Financial Conduct Authority, FCA, and the Payment Systems Regulator, PSR, are going to be the big bosses in charge of overseeing stablecoins. These guys will make sure everything is ticking along nicely. Oh, and here's an interesting one. Crypto firms will have to get themselves registered with the regulators no matter where they're based in the world. So whether you're in the UK or halfway across the globe, you better make sure you're meeting the requirements. And there's more. Crypto exchanges will have to make mandatory disclosures whenever they list a new asset on their exchange. That means they need to spill the beans on what they're listing. No secrets allowed. So it looks like the UK is taking a step towards wrangling in the Wild West of crypto. Get ready for some new rules and regs, folks. So let's talk about personal finance and the magnificent 7-inch stocks that are making waves in the market. These 7 stocks have proven themselves to be top performers, and it's important to take a closer look at each one. First up, we have Apple, which dominates the US smartphone market and has a strong capital return program. Then there's Microsoft, known for its dominant desktop operating system and involvement in AI. Alphabet, the parent company of Google, holds a significant share of global internet searches and owns YouTube. Amazon, on the other hand, takes the crown for about 40% of all U.S. online retail sales and is a leader in cloud infrastructure. NVIDIA is enjoying a virtual monopoly in AI-accelerated data centers, while Meta Platforms owns major social media platforms and is heavily invested in AI. Lastly, Tesla is a leading electric vehicle manufacturer and the only one generating a profit in its field. These stocks have consistently outperformed the S&P 500 index, but they do come with a hefty price tag. Traditional valuation methods like the price-to-earnings ratio might not be the best way to gauge their potential, considering their high-growth nature. Instead, it's more appropriate to focus on their future cash flow. Looking at their forward-year cash flow, we can see that Tesla is the most expensive, followed by Apple and NVIDIA. Surprisingly, Meta Platforms appears more affordable. However, it's important to note that Meta has faced challenges due to ongoing losses from its metaverse and virtual reality projects, as well as uncertainties related to the US economy. Despite these concerns, Meta has a strong track record and is poised for growth. While the magnificent 7-inch stocks have experienced a recent decline in market value, this is likely just a temporary setback. These companies are solid performers, and we believe they will continue to thrive in the long run. So, if you're considering investing in the Magnificent Seven, Meta could be a good choice. Have you ever heard the saying, the stock market is designed to transfer money from the active to the patient? Well, it's a personal finance quote to ponder on today. Investing in the stock market can be a roller coaster ride, with ups and downs, twists and turns. But what does this quote really mean? You see, there are 2 types of investors out there, the active ones and the patient ones. The active investor is the one who jumps in and out of the market, constantly buying and selling based on short-term trends and trying to time the market perfectly. But here's the thing, the stock market can be unpredictable, and trying to time it is like chasing a moving target. On the other hand, we have the patient investor. This is the person who takes a long-term approach to investing. They understand that the stock market goes through cycles, and instead of trying to time the market, they focus on staying invested over time. They know that patience can be rewarded in the stock market. So if you think about it, this quote is suggesting that those who are patient, who resist the urge to constantly trade and stay invested for the long haul, are the ones who tend to come out on top. They have the potential to benefit from the growth of the market over time. Of course, every individual's financial situation and risk tolerance is different, so it's important to do your own research and seek professional advice before making any investment decisions. But it's definitely worth considering the wisdom in being patient when it comes to the stock market.
In this episode, we covered the fear-driven U.S. markets, the potential impact of the Israel-Hamas war on oil prices, the S&P 500 losing streak due to rates, the UK's gradual regulation of crypto, the top stocks including Meta's investment potential, and how the stock market benefits patient investors over active ones. Thanks for tuning into the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe